It's time for Money Management Monday. Today we're here with Dow Chemical Employees Credit Union accountant Allison Lutren. Thanks so much for joining us today.
Thank you.
So we're talking today about what to do if you can't pay your credit cards anymore. So what is the first thing that you should do?
So if you can't make a payment, the first thing you want to do, you definitely want to try as hard as you can to make that payment. But as soon as you know that you can't, even if it's a couple of weeks before your payment's due, if you know that you can't make that payment, you want to call the lender and let them know. They're more than likely going to make some sort of an arrangement with you and kind of keep that relationship. You want to keep that, especially if it's any sort of a credit card, that kind of thing, it can really affect your interest rate. So you want to try to make the minimum payment if possible, but you also want to try to make arrangements so that you can make the payment maybe at a different time, but somewhere before that 30, 60, 90 delinquency day, because those are going to start getting reported on your credit report.
So is there any rule of thumb on how much credit card debt is manageable?
It's going to depend on who you are personally, but experts would say it's going to depend on your credit utilization ratio, and they want to keep that around 30%. So if you think about it, you have, a certain amount of credit available to you. You have 5 credit cards at $1,000, something like that. You want to use about 30% of that available and then keep that rest. That shows lenders that you have credit extended to you that you're not using. So you have that kind of thought that you shouldn't be using all of your credit and you're not extending it too far.
Sure. So what should you do if you miss a payment?
If you miss a payment, you want to make sure that you let the lender know, like I said, as soon as you can, that you can make an arrangement. But if you miss a payment, you want to try to make the payment before the 30-day delinquency. So what people don't understand is that a creditor can't actually report that your payment was late until you're at 30 days. So if you make the payment late, but before the 30 days, it's not necessarily going to be reported on your credit report. But 30, 60, 90-day delinquencies are all reported individually. So if you have 5 times that you've missed a payment 60 days delinquent, that's reported on your report 5 times, and that can be out there for 7 years or as long as you have the trade line. So
yeah, that's not so good.
No.
So we're talking about this. How can missing a payment affect your interest rate?
So if you miss a payment and you go delinquent, the creditor that you're actually delinquent with, so just the card that you're delinquent on, can actually give you a penalty rate if you're past the 60 days. And they can do that for up to 6 months. So you could have a penalty rate which would be in your agreement with them. It'll be something extremely high, and you'll have that rate for about 6 months until you make consistent payments. If you don't make consistent payments, they're going to keep stretching that penalty rate. So that can really increase how much you're paying and then kind of make it harder for you to pay off that debt. Another thing that you have to think about too is that's going to be reported. So in the future, if you try to get a different card with them or a different creditor, they're going to see that. So it's going to drastically affect the rate that another person or another lender is going to give you.
And how about your credit score?
So your credit score is going to be affected every time that you have a delinquency payment, and that's reported. So every time you're 30 days delinquent, one 30-day delinquent payment can drop you at even 100 points. I mean, like that. So missed payments are a huge thing that people don't realize actually affect your credit score. And then that score is what they're going to use looking at those delinquency payments for other interest rates in the future.
So what are some other options for paying off your debt?
Paying off your debt, you can look at things like consolidation if it's right for you. The thing with consolidation is you have to be ready to really pay off your debt. So if you think about it, if you have 3 cards, they're all maxed out, and you consolidate to a loan or a personal loan in an institution, that's great. You're going to have a fixed payment. You're going to be able to know when you're paying it off. But that also opens those 3 cards back up with all of that credit lent to you. So you have to know that you either want to get rid of those cards, cut them, close the trade lines, which would hurt your credit score a little bit. But you don't want to get to a point where you consolidated the debt that you already couldn't manage and then you created a little bit more. So you just have to make sure that you're conscious of what you really want to pay off when you consolidate. If you feel like you have too much debt to manage and you're to a point where consolidating isn't going to work because you also can't make that payment, you definitely want to look at talking to something like a CPA or a bankruptcy attorney, something like that. But definitely start with your financial institution. They'll be able to kind of take a look for you and help, or even maybe just an advisor to look at kind of where you're at with your expenses as far as your income coming in.
Well, thank you so much for being with us today. Some great information. We appreciate it. If you want to learn more about today's topic, head on over to the TV5 Facebook page. We will be there live after the news at 9 is over, answering your questions.